The year was 2013. It was a time of recovery and reflection. The world was still reeling from the financial crisis that had shaken the very foundations of the global economy. People were wary, cautious, and skeptical of the financial systems that had failed them so spectacularly. The financial crisis was still fresh in everyone's minds. The memories of lost jobs, foreclosed homes, and shattered dreams were vivid and painful. Trust in traditional financial institutions was at an all-time low, and the general sentiment was one of disillusionment and frustration. Wall Street, once an enigmatic fortress of wealth, had been exposed as a playground for the rich and powerful. The intricate web of high-stakes trading and complex financial instruments had left the average person feeling alienated and powerless. The stock market, with its jargon and barriers, seemed like an exclusive club that only the elite could access. Average Americans felt betrayed, locked out of a system that seemed rigged against them. The barriers to entry were high and the costs associated with trading were prohibitive for many. It was in this climate of distrust and disenfranchisement that Robinhood emerged, promising a new way forward. Two young Stanford grads, Vlad Tenev and Baiju Bhatt, promised to democratize finance to empower the everyday investor. They envisioned a world where financial markets were accessible to everyone, not just the wealthy. Their mission was clear: to break down the barriers that had kept so many people from participating in the stock market. Their weapon of choice? Zero-fee trading. By eliminating the traditional fees associated with buying and selling stocks, Robinhood aimed to make investing accessible to everyone. The simplicity and user-friendly design of their app made it easy for anyone to start trading, regardless of their experience or financial background. Robinhood's message resonated instantly. Investing, once the domain of expensive brokers and complicated fees, was now accessible to everyone with a smartphone. The app's intuitive interface and educational resources empowered users to take control of their financial futures. It was a game-changer, opening up opportunities for millions of people who had previously been excluded from the world of investing. It was a revolution, a chance to rewrite the rules of the game. Robinhood's approach was disruptive, challenging the status quo and forcing traditional brokerage firms to rethink their business models. The excitement was palpable and the potential for change seemed limitless. But like all revolutions, it came with its own set of complexities and unintended consequences. The ease of access to trading also meant that inexperienced investors could make impulsive decisions, sometimes with significant financial repercussions. The very features that made Robinhood appealing also introduced new risks and challenges. Robinhood's rise was meteoric, but its path was paved with controversy. From technical glitches that halted trading to accusations of gamifying investing, the company faced scrutiny from regulators and criticism from the public. The promise of free trading came with a cost, and the debate over Robinhood's impact on the financial landscape was far from settled. The question remained, was Robinhood truly a force for good, or was this free trading utopia too good to be true? As the company continued to grow and evolve, it became clear that the answers were not simple. Robinhood had undeniably changed the game, but the long-term effects of this revolution were still unfolding. The story of Robinhood was a testament to the power of innovation, but also a reminder of the complexities that come with disrupting established systems. Vlad Tenev and Baiju Bhatt weren't your typical Wall Street types. They were far from the image of the traditional finance mogul. Instead of pinstripe suits and power ties, they wore hoodies and sneakers, embodying the spirit of Silicon Valley more than Wall Street. They didn't wear pinstripe suits or boast Ivy League pedigrees. Their journey began in the hallowed halls of Stanford University, where they were more likely to be found in a computer lab than a lecture hall. These two math whizzes from Stanford had spent their college years building high-frequency trading platforms, diving deep into the world of algorithms and data. They were fascinated by the mechanics of the financial markets, but they were also acutely aware of its flaws. Witnessing firsthand the inherent inequalities of the financial system, they saw a world where the rich got richer, while the average person struggled to get a foothold. The financial crisis of 2008 had laid bare the systemic issues, and they were determined to find a solution. They saw how the little guy, the average Joe, was shut out, forced to navigate a maze of fees and complexities. Traditional brokerage firms were charging exorbitant fees, making it nearly impossible for the everyday investor to participate meaningfully in the stock market. They knew there had to be a better way. They spent countless nights brainstorming, sketching out ideas on whiteboards, and debating the best approach. They were driven by a vision of a more inclusive financial system, one that would empower individuals rather than exclude them. Their solution? Eliminate the middleman. They realized that by leveraging technology, they could create a platform that would bypass traditional brokers altogether. This would not only reduce costs, but also simplify the trading process, making it accessible to everyone. Cut out the expensive brokers and their commissions. They envisioned a world where trading was as easy as sending a text message, where anyone with a smartphone could buy and sell stocks without worrying about hidden fees. They envisioned a platform where anyone, regardless of their background or bank account, could trade stocks for free. This was a radical idea, one that challenged the very foundations of the financial industry. But they were undeterred. Thus, Robinhood was born, a name that embodied their mission to take from the rich and powerful and give to the everyday investor. The name itself was a nod to the legendary outlaw who stole from the rich to give to the poor, a fitting metaphor for their disruptive vision. They believed in the power of technology to level the playing field, to democratize access to the markets. They wanted to create a financial system that was fair and transparent, where everyone had the opportunity to build wealth. Little did they know, their idealistic vision would soon disrupt the entire financial industry. Their platform would not only attract millions of users, but also force traditional brokerage firms to rethink their business models. Robinhood was more than just a company, it was a movement, a catalyst for change in an industry that had long resisted it. The concept seemed impossible. A trading platform that offers commission-free trades? It sounded too good to be true. For decades, traditional brokers charged fees for every trade, making it costly for the average person to invest in the stock market. So, how could a company like Robinhood disrupt this long-standing model and still turn a profit? How could a company offer free trades and still make money? The answer lies in a practice that has stirred quite a bit of controversy in the financial world. Robinhood's business model hinges on something called payment for order flow, or PFOF. This practice, while not new, has been brought into the spotlight by Robinhood's rise to prominence. Robinhood's secret sauce was a controversial practice called payment for order flow, or PFOF. Essentially, when you place a trade on Robinhood, the company routes your order to high-frequency trading firms. These firms, like Citadel Securities, pay Robinhood a small fee for the privilege of executing those orders. This fee is how Robinhood makes money without charging you a commission. In simple terms, Robinhood routed its users' trades to high-frequency trading firms like Citadel Securities, who paid a small fee for the privilege of executing those orders. This arrangement allows Robinhood to offer commission-free trades to its users, but it also raises some important questions about transparency and fairness in the market. Who paid a small fee for the privilege of executing those orders? Critics argue that this practice creates a conflict of interest. They claim that Robinhood might be incentivized to route orders to the highest bidder rather than the firm that offers the best execution price for the user. This could potentially lead to worse trade prices for Robinhood's customers. Critics argued that this practice created a conflict of interest, as Robinhood was incentivized to prioritize the profits of these high-frequency traders over the best execution prices for their users. This has led to a heated debate in the financial community about the ethics and implications of PFOF. As Robinhood was incentivized to prioritize the profits of these high-frequency traders over the best execution prices for their users. However, Robinhood counters this argument by stating that PFOF allows them to subsidize free trades, making investing accessible to everyone, especially those who might not have been able to afford traditional brokerage fees. Robinhood countered that PFOF allowed them to subsidize free trades, ultimately benefiting the little guy. They argue that by eliminating trading fees, they have democratized access to the stock market, allowing more people to invest and grow their wealth. This has been a significant selling point for Robinhood, especially among younger, tech-savvy investors, ultimately benefiting the little guy. They argued that traditional brokers, with their hidden fees and opaque practices, were the real villains. By contrast, Robinhood's model is more transparent and user-friendly, appealing to a new generation of investors who value simplicity and low costs. They argued that traditional brokers with their hidden fees and opaque practices were the real villains. Traditional brokers often charge a variety of fees that can eat into an investor's returns, making it harder for the average person to build wealth through investing. Robinhood's approach challenges this model, pushing the entire industry towards greater transparency and lower costs. The debate raged on, with no clear consensus. Some experts believe that PFOF is a necessary evil that allows for commission-free trading, while others see it as a practice that undermines market integrity. The truth likely lies somewhere in between, and the ongoing discussion will shape the future of trading platforms like Robinhood. But one thing was certain. Robinhood had rewritten the rules of the game, forcing the entire industry to rethink its approach to pricing and transparency. Whether you view Robinhood as a hero or a villain, there's no denying that it has had a profound impact on the financial world, forcing the entire industry to rethink its approach to pricing and transparency. As the debate continues, one thing remains clear: Robinhood has changed the landscape of retail investing, and its influence will be felt for years to come. Riding the bull market. Robinhood's meteoric rise and mass appeal. Robinhood's arrival coincided with a period of unprecedented market exuberance. The bull market raged on, fueled by cheap money and a tech-driven boom. Millennials and Gen Z, digital natives who grew up with smartphones in hand, flocked to Robinhood's sleek, gamified platform. They were drawn to its simplicity, its intuitive design that felt more like a video game than a stuffy brokerage account. Suddenly, everyone was an investor. Stories of ordinary people striking it rich, turning a few $100s into life-changing sums, flooded social media. The fear of missing out, the allure of easy money was intoxicating. Robinhood became synonymous with this new era of investing, a symbol of empowerment and accessibility. But as with any gold rush, the line between opportunity and risk began to blur. Scratching beneath the surface, hidden fees, and the gamification debate. As Robinhood's user base swelled, so did the scrutiny. Critics pointed to the app's gamified features, the confetti animations and celebratory push notifications, as evidence of a more sinister motive. They argued that Robinhood was exploiting behavioral biases, encouraging risky trading behavior among inexperienced investors. The lack of proper risk disclosures and educational tools only amplified these concerns. Furthermore, the promise of completely free trading turned out to be not entirely accurate. Hidden fees, such as charges for margin trading and gold subscriptions, lurked in the fine print. Robinhood argued that these fees were clearly disclosed and optional, but the optics were damaging. The perception of transparency, a cornerstone of their brand, was beginning to erode. This is just a start. There are still